The bear case for Ovintiv has several factors that contribute to a more cautious or bearish outlook for the Ovintiv. These primary risks include a high absolute debt level, exposure to weak natural gas pricing, and the inherent execution risks associated with the ongoing portfolio transformation. While Ovintiv's leverage ratios are currently manageable, its absolute debt level remains substantial. As of late 2025, net debt was approximately $5.2 billion. While the company is rated investment grade and has a clear path to reducing debt below $4 billion, a prolonged downturn in commodity prices could disrupt this trajectory. In a low-price scenario, such as $50 WTI, the company's free cash flow would drop to approximately $1 billion annually. Under such conditions, the pace of debt reduction would slow significantly, potentially forcing a choice between maintaining share buybacks and protecting the balance sheet. This structural sensitivity to oil prices is a key concern for investors focused on downside protection.
Ovintiv remains heavily exposed to natural gas, particularly in Western Canada. Weak pricing at the AECO hub has historically been a major headwind for profitability. Although the new Vista acquisition reduced Ovintiv's AECO exposure to roughly 25% of its Montney gas volumes, the overall cash flow profile remains sensitive to broader North American gas market dynamics. The bear thesis argues that until significant LNG export capacity comes online, specifically LNG Canada and Cedar LNG, the Western Canadian gas market will remain oversupplied and prone to extreme price volatility. Any delays in these infrastructure projects would keep local gas realizations depressed, limiting the upside of the Montney growth strategy. The two-basin strategy hinges on the successful and timely divestiture of the Anadarko Basin assets. The market for SOCK/STACK, mid-continent, acreage has been uneven, and there is no guarantee that Ovintiv will receive its targeted valuation of $1.3 billion to $1.4 billion. If the sale process is delayed or the proceeds are lower than expected, the company's deleveraging timeline could be pushed into 2027, delaying the transition to a higher capital return model.
The bull case for Ovintiv is built on three central themes: industrial-leading capital efficiency, deep premium inventory duration, and a compelling valuation relative to large-cap peers. Ovintiv's focus on execution has enabled it to maintain production levels while reducing capital requirements. In 2025, the company lowered its capital guidance by $50 million at the midpoint, while simultaneously raising production targets. This ability to do more with less is a hallmark of the company's operational strategy. For the full year 2025, Ovintiv projected free cash flow generation of approximately $1.65 billion, assuming a commodity price deck of $60 WTI and $3.75 NYMEX natural gas. The company's break-even prices are among the lowest in the sector. Management has stated that the total company post-dividend break-even price is under $40 WTI. This low-cost structure provides a significant margin of safety, ensuring that the company can continue to fund its base dividend and maintain production even in a volatile commodity environment.
One of the historical criticisms of Ovintiv was its perceived lack of Tier 1 inventory compared to Permian-focused rivals. However, the aggressive M&A strategy from 2023 to 2026 has largely mitigated this risk. Through the acquisition of NuVista and the ground game of bolt-on deals in the Permian, the company has added over 3,200 premium drilling locations at an average cost of $1.4 million per location. The company's core asset performance as of the third quarter of 2025 highlights the balance of its portfolio. Permian Basin produced 210 megabarrels of oil per day with a 79% liquids weighting. Strategy focuses on cube development, trimul-frac, and inventory growth. Montney Formation produced 318 megabarrels of oil per day with a 26% liquids weighting. Focus is on rapid scale, NuVista integration, and condensate recovery. Anadarko Basin produced 102 megabarrels of oil per day with a 60% liquids weighting. Currently serves as a free cash flow harvest asset with a low decline rate, pending its planned divestiture. The Montney, in particular, has emerged as a world-class resource play for Ovintiv. With the NuVista deal, the company now controls approximately 510,000 net acres in the basin. The Montney's multi-layered stack allows for repeatable, high-return development, and the company's ability to capture condensate, which often trades at a premium to WTI, enhances the basin's economics.
Part 2. Financial performance and valuation. Ovintiv's financial results in 2025 demonstrated a robust ability to beat consensus estimates and generate meaningful cash flow. In the second and third quarters of 2025, the company delivered cash flow per share of $3.51 and $3.47 respectively, consistently outperforming analyst expectations. Comparative valuation. Relative to its peers, Ovintiv trades at what many analysts consider a discount. On a forward PE and EV to EBITDA basis, the stock often trails Permian pure plays. For instance, while EOG Resources maintains a PE ratio, TTM, of approximately 11.3x and Devon Energy sits near 51.1x, Ovintiv's KE ratio is approximately 49.9x. Operating margins. Ovintiv reports a 23.1% operating margin, comparing favorably to Devon Energy's 15.6% but trailing the top end of EOG Resources of 24.5% to 33.4% range. Dividend and FCF yield. Ovintiv offers a dividend yield between 2.6% and 3.0%, while peers like EOG and Devon offer yields closer to 3.5%. However, Ovintiv's free cash flow yield, LTM, is a robust 16.6%, outperforming EOG's 12.4%. Price to sales. Ovintiv trades at a PS ratio, TTM, of 1.3x, similar to Devon Energy and significantly lower than EOG's 2.6x. Bulls see this valuation gap as an opportunity for re-rating as the company achieves its debt targets, while bears view it as a justified discount for the company's higher debt load and gas exposure.
Part 3. Company Overview. The corporate evolution of Ovintiv represents one of the most significant portfolio transformations in the North American exploration and production sector over the last decade. Formerly known as Encana Corporation, the company has methodically shed its identity as a sprawling, gas-weighted explorer to emerge as a high-graded dual-basin operator focused on the premier oil and condensate windows of the Permian and the Montney. As of early 2026, the company has finalized a series of multi-billion-dollar acquisitions and divestitures that have fundamentally altered its risk-return profile, positioning it as a top-tier vehicle for free cash flow generation and disciplined capital return. The strategic pivot of Ovintiv is defined by a relentless high grading of assets. Since 2023, management has executed a series of transactions designed to concentrate capital in basins where the company possesses a demonstrable competitive advantage in drilling and completion efficiency. This reorientation culminated in the 2024-2026 transformation period, characterized by the exit from the Bakken and Uinta basins and the consolidation of the Alberta Montney and Texas Midland Basin. The company's major portfolio movements over this period include Encana Permian acquisition, closed 2023, a $4.3 billion transaction that added significant acreage in the Midland Basin. Bakken divestiture, closed 2023, the complete exit from the company's Bakken position. Uinta divestiture, closed 2025, the sale of nearly all Uinta Basin assets for $2 billion to fund Montney expansion.
Paramount Montney acquisition, closed 2025. A $2.3 billion all-cash deal for oil-rich assets in the Alberta Montney. NuVista Energy acquisition, closed 2026. A $2.7 billion strategic consolidation of the core Alberta Montney. Anadarko divestiture, planned 2026. Estimated to fetch approximately $1.3 to $1.4 billion. This sale involves all remaining Anadarko Basin assets. The acquisition of NuVista Energy and Montney consolidation. In February 2026, Ovintiv completed its acquisition of NuVista Energy Limited for approximately $2.7 billion, CAD $3.8 billion, a transaction that serves as the cornerstone of its Canadian growth strategy. The deal added approximately 100,000 barrels of oil equivalent per day, MBOED, of production and 140,000 net acres in the core of the oil-rich Alberta Montney. The strategic rationale for this acquisition was multifaceted, focusing on inventory extension, infrastructure synergies, and marketing diversification. The NuVista assets are directly adjacent to Ovintiv's existing Pipestone and Wapiti acreage, allowing for the seamless integration of operations and the capture of significant economies of scale.
Management expects to realize approximately $100 million in annual synergies, primarily through capital and operational efficiencies. Furthermore, the acquisition adds roughly 930 net 10,000-foot equivalent drilling locations, which extends Ovintiv's Montney oil inventory to a robust 15 to 20 years. This addressable runway is critical for the long-term sustainability of the company's durable return strategy, as it mitigates concerns regarding inventory exhaustion in high-margin areas.
To fund this expansion into the Montney and Permian and to maintain balance sheet integrity, Ovintiv has aggressively divested non-core assets. The sale of the Uinta Basin assets in early 2025 for $2.0 billion provided the necessary liquidity to bridge the acquisition of Paramount Resources' Montney assets. However, the most significant strategic exit is the planned divestiture of the Anadarko Basin assets in Oklahoma, slated for completion by the end of 2026. The Anadarko assets, while productive and cash flow positive, no longer fit the company's criteria for high-intensity multi-well pad development. In the third quarter of 2025, these assets produced approximately 102 MBOED. The decision to sell these properties reflects a commitment to the two-basin model, which simplifies the company's operational footprint and allows management to focus its technical expertise on the Midland Basin and the Montney. Proceeds from the Anadarko sale are earmarked for accelerated debt reduction, with the goal of bringing net debt below $4 billion. A primary pillar of the bullish sentiment surrounding Ovintiv is its reputation as an operational leader. The company has consistently demonstrated the ability to drill and complete wells faster and at a lower cost than the industry average. This operational alpha is driven by a culture of innovation that emphasizes cube development and the pioneering of completion technologies like trimul-frac.
Tremofrac is an evolution of simultaneous fracturing, simul-frac, technology that allows Ovintiv to complete 3 wells simultaneously using a single fracturing spread. This technique utilizes a 3-stream approach to deliver fluid, proppant, and chemical additives into the wellbores with surgical precision. By coordinating the stimulation of 3 wells at once, the company dramatically reduces the cycle time between drilling and first production. The financial and operational impacts of trimul-frac are profound. In the Permian, the company reported that average completion speeds increased from 2,700 feet per day in 2022 to over 4,200 feet per day in early 2024, with some pads exceeding 4,800 feet per day. These efficiencies translated into direct well cost savings of approximately $125,000 per well compared to traditional simul-frac methods. Furthermore, by bringing wells online faster, the company adds incremental production days within the fiscal year, enhancing capital efficiency and accelerating the present value of the assets. Since 2015, Ovintiv has utilized cube development to manage its inventory. This approach involves the simultaneous drilling and completion of multiple wells across stacked pay zones. By developing the entire column of resource at once, the company avoids the parent-child well interference issues that often degrade productivity in older shale plays. In the Permian, this strategy has led to oil type curves that have improved by 10% over the last 3 years, even as the basin matures.
The integration of the NuVista assets provides a new canvas for these techniques. Management plans to apply its expertise in large-scale pad development and water recycling to the newly acquired Montney acreage, targeting a $1.5 million per well cost reduction from legacy NuVista drilling costs. This synergy realization is a critical component of the post-acquisition financial model. Regulatory environment. Ovintiv's operational footprint across the U.S. and Canada requires it to navigate 2 distinct regulatory regimes. The Canadian federal government has implemented some of the world's strictest methane regulations, targeting a 75% reduction by 2030. While these regulations impose additional costs on upstream producers, estimated at an average of 48 CAD per ton of CO2e, Ovintiv is well positioned to comply. Its low-emissions advanced facility design allows for more gas to sales and limits routine flaring at a negligible incremental cost compared to traditional facility designs.
U.S. regulatory outlook. In the United States, the regulatory environment has recently shifted toward a more favorable stance for domestic oil and gas production. The revocation of various climate-focused executive orders in early 2025 has signaled a push to reduce the regulatory burden on Permian development, particularly on federal lands. This provides a stable backdrop for Ovintiv's planned investment of $1.2 billion to $1.3 billion in the Midland Basin through 2026. Conclusion.
The analysis of Ovintiv reveals a company that has navigated a complex and ambitious portfolio transformation. By narrowing its focus to the Permian and the Montney, management has created a streamlined, high-efficiency entity capable of generating significant free cash flow across a wide range of commodity price scenarios. The acquisition of New Vista Energy was a strategic move that consolidated a dominant position in the Montney oil window and provided the scale necessary to compete with the largest independents in North America. Ultimately, Ovintiv's value proposition is tied to its ability to meet its $4 billion debt target. Achieving this milestone will likely trigger a market re-rating as the company shifts from a deleveraging story to a capital return vehicle.